Dharamshi joins us now, CIO of Value Quest Investment Advisors. 2024 has been a real breakout year for Ravi and his team. Some of their ideas like manufacturing, energy transition, betting on solar has really been extraordinary. So how will the puck move in 2025? Is it about more of the same, or we are likely to see emergence of new themes? For the small cap index, it was a good year, but for large cap index, which is Nifty, it was a return of only 8%. So all that and much more, and let's start that conversation. Ravi, first, thank you for joining us and best wishes for 2025.
Okay, good morning, Nikunj. Wish you a happy new year and wish all your audience a happy new year too. Thank you for having me. I'll take your question. Look, clearly, I think a lot of things are on the verge of changing. The trend that we have seen post-COVID seems to be stalling, and there needs to be a change in leadership. However, that hasn't happened yet. We haven't yet seen signs of that. So I would say the entire rally post COVID has been driven essentially by central government capex. And what we saw, the slowdown in the GDP number essentially was reflective of the fact that we were running only on one engine. Consumption has been lagging, exports have been lagging, rural economy has been under duress. All those things could not hold up and could not replace when a couple of 4-5 months of delay or lag in central government capex kicked in because of election related issues. So I don't think that the economy is on the verge of a major slowdown, but at the same time it exposes the fact that economy is being run only on one leg, and we need to broad base this. The efforts are on the part of the government to kickstart the real estate cycle at the bottom of the pyramid. Efforts are on to broad base the capex cycle to private sector as well, where they have left a lot of scope and room for private sector to start borrowing. And I believe the conditions are right for the private sector capex cycle to pick up. However, the signs that we have seen till now are very preliminary, and we need to see far more momentum to take to be decisive about the fact that, okay, you know what, this capex momentum will continue, will maintain, and private sector is about to take over. So that's my assessment of we are in a transitionary phase, just like the economy from the market's point of view. And of course, on the other side of the equation is the valuation, which has been bothering us. So unless the momentum sustains, valuations can become a major issue.
When I speak to in the market, they say the following: जो अच्छा है सस्ता नहीं है, जो सस्ता है वो अच्छा नहीं है. Is that true in the market right now? Good stocks are not available cheap.
It's true. It's absolutely true. But what I would say is it's been true for the last 18 months, maybe. I don't think that's only the case today. Yet there have been companies and stocks that have given returns. So it would be a little lazy analysis to say that there is absolutely zero opportunity in the market. There are opportunities. There are new segments that are opening up. There are new companies that are getting listed, and there is a certain amount of scarcity premium attached to that those kind of business models which are new to the market. Not everything is represented in our public market. So when a company which is part of a new sector tends to get higher valuation, as and when more listings happen, of course, that scarcity premium will come down. But as of today, there are certain opportunities, especially in the pockets like IPOs and certain segments like a downstream capex is where a lot of the opportunity is now flowing through.
Ravi, I'll take the conversation back, and you've been vocal about two themes, and they have done exceptionally well. One was manufacturing, especially the EMS space, and second was energy. Let's talk about both. I'll start with manufacturing, which has become more like a consensus trade now. Companies like Keynes or Dixon or Amber, they're commanding P multiples which are higher than that of FMCG companies now. Will this sustain?
See, from a longer term perspective, the manufacturing theme in India is here to stay. Whether it will be next 10, 15, 20 years, I believe manufacturing in India is on the rise, and there are confluence of factors driving that. Number one is China is facing a slowdown, and China is trying to move away from being, the manufacturing or the factory of the world to becoming a more inwardly focused, more domestic consumption focused economy. Now, that is a transition that China needs to make. So there is a need for them to move away from certain sectors. Second, world has realized that it is too dependent on China in some of the sectors and some of the strategic sectors as well. So they need to reduce their dependence. Nobody for a moment is suggesting that China is going to be replaced. But if China is 40% market share in a particular commodity, that might come down to 35% over a period of time. Or if it is 90-95%, as in the case of solar renewables, that will also come down. They cannot remain so dominant in a particular sector, because the importance of that has now been impressed upon the major economies in the world due to what happened during COVID times. And third is, of course, India needs to, replace its agriculture as the main, agri and rural economy as the main source of employment for people, and move them towards, urbanization, infrastructure, related employment and manufacturing related employment. So those are the three pillars on which the manufacturing theme is going to survive. Now, within manufacturing, there are many sectors and subsectors, and they will keep, coming into the limelight and going out of the limelight. For example, chemical was actually the first sector to take off way back in 2014, and it had a great run until 21. And then what we realized is that, China was not really vacating that space, but it was only moving its production away from residential localities to faraway localities. So when China came back into the market, there was a lot of dumping, which led to this manufacturing theme in China taking a big pause. So last 3 years, it's been on a pause, or in fact, you can even say taking a step back. Even though India might be gaining market share, but the profits have eroded for a lot of these chemical companies. The mantle moved to two sectors post 21. One was the electronic manufacturing sector, which is essentially the China plus one theme. And the second was the defense, but defense was more an import substitution story. So in the electronic manufacturing, I think we have started off on a great note, where one particular subsector, which is the mobile phones assembly, is where we have done well to take away a lot of the market share. And that has led to a lot of replacement of imports with, in fact, now we are net exporters in the mobile phone. Of course, we have to still move up the value chain. We have to add a lot more value rather than just do assembly work. But that is where we are in that stage, in that story, where the component manufacturing is now getting relocated to India. It is not only about the assembly. And I think this is where the opportunity lies in the electronic manufacturing space, where some of these component manufacturers are going to see a good tailwind for the next 5-10 years. And the story will keep moving on from components eventually to maybe full assembly or the branded guys as well. But that story is for a future date. So I remain positive on the space, but there are certain companies in electronic manufacturing which are now quoting at valuations which are very difficult to justify, and they might be capturing in next 3-4 years kind of gains. So I would be a little skeptical about placing new bets in some of these old stories. So that's my take on the electronic manufacturing space.
Okay, point taken as far as that is concerned. But Ravi, hi, first wishing you, the best of 2025. But just wanted to get a better sense from you on real estate, because that is where there is a bit of a disconnect. Because if you go by anecdotes and if you go by ground reports, it does seem like that there is enough inventory. Perhaps there is increased discounting and those, good offers that the developers kind of give. But at the same time, the story and the numbers, point out to something else. And you are also quite bullish on real estate, even for 2025.
Yeah, thank you. Happy New Year to you as well. Real estate has been a very partially bullish story since the last 3-4 years. And I don't think any other sector, epitomizes the K-shaped recovery better than real estate sector. all the recovery has primarily been on the luxury end of the market. And the reason for that is also actually very understandable, because the growth in the market has been driven more by asset inflation rather than through income growth. And basically, if you have been an owner of gold, real estate, or when I say real estate, land, or if you have been an equity investor, then your wealth has grown. And that is what is feeding into the luxury real estate cycle. But if you have been, a wage earner, income earner with not too much exposure to any of these asset classes, or you have not been an investor, then you have you have failed to keep pace with the inflation. And that is what is hurting the demand at the bottom of the pyramid. So there is a strong need to broad base the real estate cycle that we have seen till now. If we really want, broad based benefits of the multiplier effect of real estate cycle, then we need to broad base it. And what we saw in the last budget, I think, is a reflection, and also that government understands it. So when we saw that actually the government ended with fewer seats than one would have expected, the natural bent of mind was that, okay, now we are going to see a lot more fiscal indiscipline or money being spent rather than towing the fiscal discipline line. What they said is instead, like, they are going to build 3 crore affordable homes. Now that is still continues to basically feed into the supply side reforms and the economy, that economic tool that government has been using to revive, which is continue building houses, continue to revive the demand in the real estate cycle. Now, I think one big factor that has been missing is that the liquidity has been tight from the RBI side, and also interest rates have remained elevated, which has kind of further aggravated the situation in the real estate cycle, especially at the mid and the bottom level of the pyramid. I think both those factors are about to change from the RBI side, and I hope from the government side as well. Though I'm not so sure if it will be the central government, but already we are seeing signs of some amount of fiscal, well, indiscipline would be a strong word, but money being spent by the state governments. So whichever government, whichever state is going into election is actually leading to some amount of spending in the economy. And I think that is giving a lot of support to the rural and the consumption cycle. So I am hopeful that this cycle will revive, and the real estate cycle will get broad-based over the next 2-3 years, though we cannot be sure of what exactly will happen in the next 3-4 months.
Ravi, in continuation to that, do you think the consumption theme is here to stay, and would it continue to have that premium bent to it?
So I think a lot of things have changed in the consumption cycle. I think earlier we used to associate consumption with FMCG or the consumer staples. I think a lot of the categories over there are penetrated beyond 40-50%, and all the growth over there is basically distribution growth. We used to say there are 6 lakh retail outlets, and X particular company has only yet penetrated into 1 lakh outlets, and there is still so much scope for those products to grow. But now today, I think that penetration levels have reached kind of a saturation level, and also I think the nature of consumption is changing. People have probably started, this quick commerce is probably taking away a lot of that growth towards itself. So that is impacting the growth of the traditional distribution outlets. So that, I think, is what is ailing the consumption. However, there are certain pockets within consumption that you can see where there are signs of revival, and one should be betting. So, for example, we just made a point that the real estate cycle needs to broad base and has not done well. But if this was to happen, that real estate cycle broad bases, I think the building materials segment, which is dependent on this real estate cycle, will start seeing an upcycle as well. So, and that is kind of a quasi-consumption place. Once you have bought a house, and then you're going to spend a lot on things that go inside a house essentially. So consumption is in a phase of transition. I won't say we are on the verge of a revival, but I think further deterioration should stop somewhere around here. And maybe stocks from a longer term perspective have started looking more reasonable than they have been in the recent past.
Energy transition. I mean, that is something which, in a sense, you've been very, very vocal about. That theme is the mega transition theme, which, as a house, you've been advocating. Let's look at the plus and the minus here. The plus here is that energy transition is the real deal. Energy transition is something which is the global need of the hour, and companies and countries will invest in it. But this is again a regulated sector. And if one really looks at, let's say, solar, it's a sector where Indian companies are growing because they're protected. And is it a good idea to buy into any business which is going up because of protection advantage?
No, Nikunj, thanks for that question. I think a lot of thinking in this particular direction is first level thinking. And I think people fail to understand the strategic nature of this sector. By the way, had the protection not been there, you think steel sector in India can survive Chinese onslaught? Do you think auto industry in India can survive without the kind of barriers that there are there? I don't think so. And this is a strategically important sector. One has to understand that this is not purely being driven only by economics. The stool that this particular theme stands on is energy security, energy independence, and economics, of course. So economics are today in a stronger place because we have the protection. But the protection is being driven by the need to have that energy security and energy independence. If I were to say, what ails India from a very, very macro point of view, it is the fact that we import more than we export, and we consume more than we produce. Essentially, the fiscal deficit and the trade deficit. And if one has to go about attacking these longer term issues, then the top two things where we are importing the most is, I'm not counting gold because we don't have an answer to gold. Gold, we will remain an importer. But aside of gold, electronics and energy are the two biggest items that we tend to import. And if we have to become energy secure, energy independent, then we will have to start producing renewables, because we are not finding any more oil within the country. And in fact, it is probably going to go out of fashion in another 10 years to even rely on oil exploration. It's a industry that is matured for sure, and worldwide, in fact, it has started declining. In India, it will remain a growth area for some more time, whether it is coal or crude, but it is not going to be a growth area where money is going to be spent. Now, and solar is abundantly available. We need to be able to produce our energy ourselves. In fact, we will become an energy exporting nation in 10 years' time. And I know it is very difficult to believe at this point of time, but yes, that's what's going to happen. Now, energy transition is essentially moving away from fossil fuel towards renewables. Within renewables, solar is the biggest piece. And this, what is unique about this particular energy transition as against other previous transition is that it is being driven by manufacturing. Essentially, when we were drilling oil, there was no money going into factories which are depreciating assets. Today, now factories are being put up and it is a depreciating asset, and one needs to keep those factories running. So naturally, there is some amount of efficiency improvement, learning curve involved, through which the prices keep falling. So from that perspective, also it is important that we don't remain dependent on a foreign nation, which could be potentially a rival nation, for our needs on the supply chains part. So we need to secure our supply chain. We need to give it the window of opportunity to build the assets, so that we don't make the same mistakes that we did in the fossil fuel, which is we remain dependent on the oil producing nations. And we finally have, a trade deficit which does not hurt us anymore. So a depreciating rupee is what we have seen, and the two biggest reasons I mentioned are fiscal deficit and trade deficit. If we can get those two under control, imagine the kind of currency strength that we will achieve, and that will be the real wealth creation that will happen in India. Today, the wealth is getting created, but it is limited to certain assets, and it is limited to the assets that are growing faster than the inflation plus rupee depreciation. So in real sense, we are not growing as rich as we should be. And for that, we need to address those structural issues. And that is where solar fits in. The strategic nature of that sector demands that protection of the sector remains for a long period of time. And in fact, if you see the government action, it is exactly in that direction. So it would be foolhardy to make your investment decision saying that, okay, these are all only driven through protection. So they don't deserve to be trading at the valuation that they are trading.
But you're right, perhaps a couple of those macro and structural issues also need to be looked at. But Ravi, what about financials? I think by and large, you've been staying away from that. But given the kind of underperformance, does the risk reward seem favorable now?
So financials is a very, very broad sector. I mean, it includes insurance company, life insurance, general insurance, lending, non-lending. In the lending, it includes private sector banks, NBFCs. Within NBFCs, there are asset lenders, gold lenders, affordable housing finance companies. So there are various segments, and the drivers of each segments are not necessarily the same. However, I guess from your point of view, the question you are asking is more towards the large private sector banks, because they are the biggest component in the indices. I do believe the best in terms of the asset quality, the best in terms of the credit deposit ratio, the deposit growth is probably behind us. Deposit growth will remain in a 12-13% kind of a range. So that by default means that the credit growth cannot exceed more than 15%. So this challenge will remain for the coming period. But the NIMs that were compressing because of the cost of deposit, I think that should start easing with the hopefully the interest rates also coming down and the liquidity being improved through the CRR cut. So I would say one has to reset the expectations in terms of what is the kind of growth one should expect and what is the kind of return ratios one should expect. This sector is not going to be a 20% grower and a 20% ROE, which the investors have been used to for the past 15-20 years. Now it will probably be a 12 to 15% grower with a 12 to 15% kind of ROE. And if one adjusts to that fact, then I think from that perspective, the valuations are now becoming really, really attractive. And one should be long on this place with a 5 years perspective.
Many more interactions in the year to come. Thanks as always for taking the time out.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.